Dear friends and investors, welcome to our monthly video on markets and investing. So what are we going to talk about this month? For sure, we will talk about the most important event in the economic calendar, which is the budget. While budget is very important, I think over the years, as you would have known, that the impact of the budget has considerably reduced when it comes to economic affairs and markets, because there is a lot that happens not only in the budget but outside the budget. Secondly, now that we have a separate GST council, a lot of the tax changes, especially on the indirect side, have now moved to the GST council, and therefore all that the budget has to really look at from a tax perspective is direct taxes. Having said that, I think it's important to talk about the budget because in many senses the budget gives you the basic thinking and the philosophy of the government when it comes to policy making. And I think in that respect, this budget in every which way was a fantastic budget. Yes, it was a continuation of what I believe was a turning point in India's economic thinking and policy making, which actually started with last year's budget. So in many ways, this budget was a continuation of last year's budget, and in fact a continuation of a certain government philosophy which is very important, which actually started from September 2019 when the government cut corporate tax rates to very, very competitive levels. And I think from there started the journey, and then it was carried forward further into last year's budget, and again this year's budget has to be seen in continuation of a series of steps that the government has been taking. But let's come to this year's budget. I think without boring you with numbers and minute details, all of which I'm sure you would have either read in the newspapers or would have seen various stakeholders talking on various business channels, and therefore I do not want to waste your time and repeat many of those minute technical details. But I'm going to spend a few minutes on what I believe are the key philosophical underpinnings of this budget. Very clearly, this government has focused on growth driven by capital investment, spending on infrastructure. And I think this is very, very important because I think in India, growth solves a lot of problems. Once you have growth, you have jobs which are created, you have incomes that go up, you have phenomenally good tax revenues as we have seen last year. And once you have very good tax revenues, you are then able to spend the money on social sector and on infrastructure, health, education, a lot of these areas which are extremely important both from an economic and from a social point of view. And therefore the thinking that you tax the rich, increase tax rates, and then spend on social and infrastructure issues, I think that thinking has now clearly been set aside, and I think very clearly the government has signaled that it is voting for growth, and more so because of the kind of battering that the economy took during the pandemic. I think at this stage of the economy, it is more important to drive growth rather than to worry about fiscal consolidation. And that doesn't mean that you have to be fiscally irresponsible. I think the 6.4% fiscal deficit for 22-23 in the current circumstances is fairly acceptable. And I think that if we do not kickstart growth at this stage, we will have a lot of other problems. We need to get out of the vicious cycle of low growth, low revenues, higher taxes to a virtuous cycle of higher growth, higher revenue and lower taxes. Secondly, I think that, and this is again second year in a row, that we believe that a lot of the assumptions in the budget, whether it is revenue, whether it is expenditure, whether it is the GDP growth, are conservative and realistic. I think that is been a great hallmark of the last two budgets, including this one. The government has penciled in a 11% nominal GDP growth. Clearly, they have been conservative. We believe that if real growth is 8.5% and inflation is 5 to 6, then we are likely to shoot for a 13 to 14% nominal GDP growth. And therefore, I think that there is considerable space for revenue to be much higher than what has been budgeted for. So I think a lot of the worry that markets or other participants may have about a larger fiscal deficit, I think at this stage, I would say that that is not a problem. And I think that there has been a lot of transparency and a lot of realistic assumptions that have been taken in the budget. And why I mentioned transparency again, I think last year when all the off-balance sheet items were removed and brought into the budget, and I think this year the budget has continued with that level of transparency. So I think that we are now moving away from these olden days where you had subsidies and borrowings which were largely outside the budget and which were shoved under the carpet. But I think we are having a great new beginning where the budget is not only realistic but is also very, very transparent. Next, I think, is a very important reform, which is divestment. And yes, the government did undershoot on the divestment figure because the only thing that they could divest was Air India, which in itself was a great move. And then just before the budget, they were able to sell Neelachal Ispat to the Tatas. But I think there were several other divestments which could not happen. And I think the government, in its own wisdom, has realized that rather than giving large numbers and not achieving, it is better to give realistic numbers and then overachieve. But I believe that just because the number of divestment in the budget is low does not signal any change of intent. I think the intent is clearly there that the government will disinvest, and I think that one should not get particularly alarmed by the small number of divestment that we are seeing in the budget. There was a lot of fear that ahead of the 5 state elections there will be a populist budget, it will be an election budget. I don't think any of that has turned out to be true. And I think it's remarkable that again we are getting out of that mindset where we keep tinkering, we announce grandiose social security plans and programs just to assuage a certain section of the society or people from a certain state. And I think the government is clearly steered away from any sort of giveaways or populism as was feared. And I think that's a big welcome change, that we are able to divorce politics from economics. And I think that that's a great welcome change, and it's been a great sigh of relief that there was no such populist or election budgets that people feared about. However, on this point, I would urge all of you who are really interested in trying to get a political message underlying the budget to read the column by Shekhar Gupta, which comes in Business Standard, and we will probably send you a link of that. And he had a very interesting observation where he asked the same question: was it an election budget or was it not an election budget? And I think he has a very, very important take, or a very interesting take, that depends on how you view it, right? So as I mentioned right now, that you don't find anything in the budget which suggests that it's a populist budget or there have been any giveaways. I think what Shekhar says in that article, in short, is that this is a budget for 2024, which means that what the government wants is that by the time the Modi government goes into election mode in 2024, they want the economy to be humming. They want economic growth to be solid. They want, therefore, employment to be solid. They want the feel-good factor to come back into the economy. And therefore, this budget is not really designed for the state elections of 2022, but are designed to have, again, to use the good word, achhe din in 2024. And that can only happen if the economic growth takes off. And therefore, it's quite an interesting take that in a very traditional sense, it is not an election budget. But if you were to look at it from a slightly longer term perspective, I think what the government clearly wants to do is to amp up growth so that by the time they go into election in 2024, the economy is doing phenomenally well. And I will end here on the budget by a quote which was recently given in an interview by Mr. Rakesh Jhunjhunwala, as you all know, is a co-founder of Alchemy. And I quote, he said, "There is no capitalism, neither socialism, but just realism in this country." And it is so true, right? I mean, we've all tried to say, is this government capitalist? Is this very socialist? I think what they are is more a realist. That brings me to the flip side, which is that what are the risks that we see in front of us, right? Whether emanating from the budget or otherwise. I think from a budget perspective, clearly, while a large fiscal deficit of 6.4% was the need of the hour, that would also mean a significantly higher borrowing program. And I think one risk is that the government needs to borrow roughly about 15 lakh crores this year to finance the deficit. And therefore, that needs to be managed very well. Now, so far, we've seen that the government and the RBI have actually worked in tandem. And I do believe that the borrowing will be more orderly. However, we have seen that immediately after the budget, the yields or the bond yields definitely went up because the debt markets or the bond markets are definitely worried about the large borrowing program of the government. And I think that's one risk, that if the borrowing is not orderly, it could lead in a spike in interest rates. And that's not something that we would want, though we do believe that in the natural course this year, it is a given that interest rates are likely to go up, given the fact that global interest rates are also rising. But what you don't need is a very sharp knee-jerk upward correction, upward move in interest rates. The second risk that I see is oil prices, right? Oil prices are already at $91. The budget has taken an assumption of $70 to $75. Clearly, the assumption of the government is that over the course of the year, as the global economy kind of slows down its overall growth after the massive recovery from the pandemic, oil prices will also cool off. But that's an assumption. And as you all know, that higher oil prices are clearly not very good for the Indian economy, because we still end up importing 80-85% of our oil imports. And in our view, I think India should be okay till oil prices are sub $100. But if oil prices was to go above $100, it is certainly likely to put a reasonable strain on the fiscal situation. And then maybe this large spending program that the government has planned may come under pressure. The third thing is that, as you all know, monsoons are also equally important. And they are important from the point of view of two things. One is food prices. If you have a very bad monsoon, it is quite likely that you may have food inflation, which again eats into everybody's budgets, and especially for people who are at the bottom of the pyramid. And we all know that higher food prices and higher inflation actually tax the poor more than they tax the rich. And we've spoken about this, that currently I think rural incomes have not kept up. There has been pressure during the COVID period, and there is nothing specifically in the budget in terms of a handout or a giveaway, where people have just signed off money and given it to people in the rural areas. Having said that, I think the government, to the criticism that there was nothing specifically for the rural areas, either in terms of higher allocation to Narega. In fact, the Narega allocation has been brought down a bit, because last year was it was taken up substantially because of the COVID crisis. Having said that, I think the government has subsequently, a lot of the people in the bureaucracy and the advisors to the government have come out and said that, look, the government is fairly agile, and if the need be, they can always adjust the spending on things like Narega, which will help incomes at the lower end. Having said that, there is still one risk of if in case we have a bad monsoon and there is food price inflation, that could be another risk that we need to take care of. And the last one, which we've talked about in the past, which is rising interest rates globally and the Fed tightening. And our view is that pretty much now 4 to 5 rate hikes is something that the markets know. The markets have been adjusting to that reality, and many companies which have no earnings or which had lofty valuations which cannot be explained by fundamentals or cash flows have seen a significant retreat. But I think the risk is not, in my opinion, rising interest rates. As we have argued in the past several times, that we have seen that whenever Fed rates have been increased, actually markets have given a positive return. But what we do not know is when quantitative tightening happens, which is that the Fed had expanded the balance sheet and now it is talking about reducing the size of its balance sheet. The size of the expansion of the balance sheet that was done post-COVID has never been done in the history. And therefore, there are less data points today to suggest globally what happens when there is quantitative tightening. Now, I don't mean to scare you, but I think this is something that we need to keep at the back of the mind. I think that none of the regulators or central banks would risk a recession or a severe contraction in any of their economies. So we all hope that this is done in a more gradual and orderly manner, but certainly a risk that is worth keeping at the back of the mind. Having said that, and is there going to be a significant change in our portfolio positioning as a result of what we see in the budget or what we see in the environment? Well, as we've always said, we don't change our portfolios just because something did not happen in the budget. However, we are aware of what is happening broadly in the environment. And I think if you look at our current portfolios, we are positioned in about 5 or 6 important themes. First is exporters, where we have exposure and we will continue to have a significant exposure to IT services, specialty chemicals, pharma and healthcare. So we have a range of companies, as you all know, that we've invested. in IT services. Many of them have done phenomenally well. As I've said in the past, Naya Race Ka Naya Ghoda, this bull market has a few clear leaders, which are the specialty chemicals and the IT services companies, and things like API exporters and pharma, where we are fairly well positioned. Second, we do have exposure to financials, but we are very clear that within financials we have bet on companies which will benefit from rising interest rates, and also but companies which are very well positioned in terms of their digital capabilities. And as you all know, that we have clearly voted for a Bajaj Finance and ICICI Bank in our portfolios. Both these companies, we believe, are very well positioned from a digital perspective. The third big area, which has also been a big thrust for the government, is manufacturing, with the various PLI schemes that we see, whether it is auto ancillaries, whether it is electronic manufacturing services. We also have selectively exposure to capital goods, autos, auto components, and in some cases a little bit in metals. So I think this entire pack of manufacturing, capital goods, auto components, metals, all these sectors which are likely to benefit from the improvement in economic growth and the cyclical improvement in the economy, we will have exposure there. Then we have our favorite sectors, which is the consumer discretionary, the retailers, the QSR, basically consumption driven companies which will benefit as we get out of the lockdown. We will see consumption coming back, roaring back, and we have exposure to many of the names in these sectors. And lastly, we do have a little bit of exposure to platform companies and the new economy, where, as you know, we said we will be very selective. And we will back businesses where we think that the path to profitability is clear and that these companies have leading positions in what they are doing. So I think broadly speaking, we are not going to dramatically change the positioning of the portfolio because the budget came and went. But I think broadly speaking, we are now aligned to these 4 or 5 themes that I just spoke about. So with this, I come to the end of this month's communication, and I look forward to seeing you next month. Thank you.